Assalamu alaikum, everyone. Welcome to our next session with the DFW Muslim Bar Association. Part of our series on emphasizing and providing wonderful CLEs from our members that are taking time out of their schedule to educate us on topics that they're familiar with, that they have expertise in. So we've got a wonderful session for you all today. My name is Fawaz Baum, and I'm the president of the DFW Muslim Bar Association. Wonderful to see so many of you all at the NUML conference just last week on Friday and Saturday. And great showing from our bar association, like always, at that conference. Next year's conference, inshallah, will be on the East Coast. So look forward to seeing a lot more people there as well. Part of the series, just to recap real quick, we've done a couple of these sessions on a variety of different topics. We started with the Corporate Transparency Act, which was very vital, and we delved into the nuances of that particular act. Then we moved on to Islamic wills and trusts and estate planning. And last session was regarding franchise agreements, franchises in general, and it was very well attended on all accounts. Today we have Nasher Hamid, who is an attorney and lawyer at Vincent and Elkins. He graduated from SMU in 2021 and attended UT School of Law, graduating in 2024 with the Dean's Achievement Award, being associated with business associations, and being part of the U.S. Supreme Court Clinic. He currently practices corporate finance and securities law, including securities offering, private equity, mergers and acquisition, and general corporate representation with a particular focus in the energy space, both buying and selling. Nasher is an amazing member of the DFW MBA, and we're so excited that he's taking time out to kind of educate us on today's topic, which is joint ventures. What are they? And JV agreements, how do they operate? And what should we all be looking for and considering when we hear the words joint venture or getting multiple investors involved in some sort of enterprise? So without further ado, I'll turn it over to you, Nasher. Take it away.
Thank you for the very kind introduction, Fawaz, and I love being here and maybe helping you guys learn something, and maybe I'll learn something too in the process. So let me share my screen.
I will say just some housekeeping. If you have questions and want those posed to Nasher, feel free to use the Q&A box that we have, or you can drop it in the chat. Either way is fine. As we get closer to the end, we'll share the CLE code and also go over Q&A questions at that time. Thank you.
Thank you. All right, so today I'll be speaking about joint ventures and specifically focusing on their governance and minority protections. So what is a joint venture? Well, interestingly, it'll sound a lot like a definition of a partnership. So you have a business venture established for a specific purpose by two or more parties that want to combine their resources and capabilities. But what distinguishes this from maybe a partnership or limited partnership is this is more project focused or entity focused, whereas general partnerships, limited partnerships tend to be more longer duration. And typically, the way these are set up, one JV party will have the responsibility of operating on a daily basis. This person or party typically tends to be the majority owner, whereas the minority JV parties have consent rights and other negative controls. And what we've seen is most JVs are structured as limited liability companies or LLCs. And this is what we'll be focusing on, and typically Delaware, but yes, we do increasingly see Texas. So why do a JV? And many of these reasons here explain why do business at all generally. So access complementary capabilities, products, services, meet regulatory requirements, gain scale, synergies, share risks, limit liability, and realize accounting, financial engineering benefits. So something I also spend a lot of time on is M&A. And this slide is really the biggest takeaway for people who do corporate law generally is that a JV is different from traditional M&A, whether public or private, because a JV is a much more stretched out process, whereas an M&A deal is, sometimes you'll have a staggered sign and close, sometimes you'll have a simultaneous sign and close, but you have like basically a definitive agreement and then maybe some ancillary agreements, but that's it. Once those papers are signed, like the parties basically buyer goes one way, seller goes the other way. Whereas in a JV, you have a much longer scope time wise. So this is why hashing out the relationship between the JV parties gets much more complicated and important in a JV. And I like the line halfway down the slide that says, because of this, scorched earth negotiation tactics are not optimal. So four key areas we'll focus on today are governance, transfer restrictions, the economics of a JV, and then exit events. But I think the majority will focus on the first two. So many JVs are governed by a board of managers or directors as set out under the LLC agreement, which also, in addition to specifying the authorities of the board, sets out the voting procedures, voting thresholds, and any other rights reserved by the members. And the size and composition of the board gets heavily negotiated because where you have, I guess you wouldn't have a majority or minority JV party in the case that they're 50-50 interest holders. But in that case, whenever you have a deadlock or in cases where you have supermajority consent rights, the number and composition of the board can be heavily negotiated. And typically, the board is comprised of natural persons appointed by the JV parties in proportion to their ownership interests. And by default, this kind of gives the majority JV party, the one who has the most interests and has contributed the most capital, more seats, and hence more voting power. And the downside for this for the minority holder, obviously, is that they can be easily outvoted. And one way minority JV holders can protect themselves from kind of this hegemony by the majority JV parties is by having the board not, okay, let me reword it, prevent the board from acting by non-unanimous written consent. And this more or less guarantees a minority a better voice. And sometimes you'll see an independent manager. So an independent manager typically tends to be an industry expert, and they're independent in the sense that they may not be a JV interest holder. And then the board will also be split into different committees. For example, the audit committee, compensation committee, and the minority JV party typically will try to negotiate to be on all of these committees to try to have a bigger say in the day-to-day. And then another thing that might be more of an illusory right, but kind of goes towards information and access to information is the JV minority JV party might be entitled to a one or more board observers. So imagine somebody just sitting in on a board meeting but can't vote. I guess they get to know what's happening behind, in the boardroom or, in the email chains, but they aren't actually kind of making decisions. But I guess sometimes, as you'll see, information in and of itself tends to be pretty important and valuable to have. So this slide goes over information access and audit rights at a high level. And these are rights that I understand um, all of the JV parties should have, regardless of whether they're minority or majority. These will be set out in the LLC agreement. So information rights are rights to obtain, for instance, financial statements, books or records, copies of reports delivered to lenders, notice of key events. Access rights are going to be, oh, I guess books and records goes to access rights, not information rights. But in any case, access rights, one important aspect of that is the ability to consult with management, being able to call up the board of directors or managers. And then audit rights are your ability to engage with a third party to go over the books subject to limitations. So like I mentioned before, much of a JV agreement is hashing out the relationship between the parties, and specifically as concerns the minority JV parties, fleshing out the minority protection. So we'll go over so there's affirmative rights and negative rights, and we'll be going over both of these. And as you'll see, one key theme that these minority protections give are limitations surrounding the majority JV parties' ability to transfer. And by transfer, I mean cause or affect a sale of the majority party's JV interests. So some limitations include lockups in this regard. So a lockup is where a JV party is prohibited from transferring its interests for a fixed period of time, particularly management. And this is so you kind of prevent self-dealing managers from getting their payday early and kind of leaving everybody else in the water in terms of how do you operate the day-to-day. And then you have something called permitted transfers, which concept just generally refers to the ability of a JV party, JV party's ability to transfer to entities that it has control over, for instance, affiliates. So over the next few minutes, I'll be discussing two similar but distinct terms called rights of first offer and rights of first refusal, or people typically in shorthand refer to as ROFOs and ROFERs. So a ROFO requires a selling JV party to first market the JV interest that they're selling to a non-selling JV party. So the non-selling JV party is going to, so Fawaz, if he's the selling JV party and I'm the non-selling JV party, or I'm gonna stick in the JV, he might come to me and say, hey, no, sure, my as specified in the JV agreements and the LLC agreements, you have a ROFO, which means that you get to name the price and I can accept it or not. So Fawaz, he can either accept the offer, my offer to buy his interests, and the upshot of that for me is I get more interest. I become maybe less of a minority JV party, or I can decline, or sorry, Fawaz can decline my offer, which gives him the ability to go out and market his JV interest to third parties subject to maybe other uh, transfer consent rights. And in contrast, Rofer, the way I like to think about this is if Fawaz is the selling JV party and I'm the non-selling JV party, Fawaz gets to go out into the marketplace and maybe gauge market interest, maybe enter into a LOI and get some price terms from a third party buyer. But then I get to have him come to me, the non-selling JV party, and I get to match that offer and kind of take away the deal from the third party. And you can tell this is significantly more restrictive than a ROFO and has a chilling effect because a third party is not go if they know that Fawaz's deal is subject or JV interests are subject to my ROFR in my favor, they might not want to be as inclined to spend time hashing out a term sheet only to have me take it from under their feet. And so this chart just compares ROFO and ROFR. So a tag-along right in broad strokes is the right to have the non-selling JV interest holders participate in a sale to a third party. So it's kind of like everybody gets a piece of the pie. So the longer definition of this would be a tag-along right requires a selling JV party to sell all or a portion of its JV interest to give notice of the sale to other JV parties who have the tag-along right to participate on a pro rata basis in the sale along with the selling JV party on the same terms. So even if I wasn't looking to sell, but I have a tag-along right in my favor, if Fawaz tries to sell, I get to basically participate in the upside of that sale and force the third party buyer to bring me to the deal table. And here, drag along rights are different in that it kind of is on the flip side compared to a tag along right because this is more in favor of the majority JV party because they can force me, the minority JV party, to sell my interests too, even if I wasn't looking to or didn't want to. So you're literally being dragged along into the sale without your choice. So minority holders tend to want to limit drag along rights. So now we're going to talk generally about the economics of a JV, how it works from maybe the commercial or business side of things. So the way you obtain a JV interest typically is through what's called a capital contribution. So what this means is I give some sort of consideration, either cash or it could also be services or assets in exchange for JV interests. And sometimes these can be called capital commitments in the sense that you you guarantee to provide a certain number of capital contributions. And what this helps the board do is periodically issue capital calls, which requires the investors to fund their pro rata portions of such capital calls, it not to exceed their capital commitments, subject to other negotiated conditions. For instance, the, I guess, lack of any material adverse effects. And the consequence of a failure to fund is very detrimental to the business of the JV because it can result in dilution or the withholding of distributions, which is another, I guess, term for the profits that will be given out to the JV parties. So in that regard, distributions are made pro rata subject to the rights and preferences of the classes of JV interests because there can be different, uh, I guess, classes of JV interest, for instance. And the way these get distributed, sorry, they can be called a waterfall. And it's called that because you have different layers. So, for instance, in this illustrative waterfall, you have 100% going to the A's until they get their return of capital plus 10% of internal rate of return, which this 10% in commercial terms also gets called a preference. And then the second tranche will be 90% of the distributions to the A's, 10% to the B's, until everybody gets 15% internal rate of return and 2%, sorry, two times multiple on invested capital. And then thereafter, I guess the third would be tranche would be 80% to the A's and 20% to the B's. So if the business of the JV goes really well, one exit strategy is an IPO. Um, I haven't quite seen this yet. Maybe more senior lawyers have, but at least when I was in law school, my understanding was, hey, IPOs take a lot of the average IPO, I want to say, I think costs upwards of a minimum, maybe $1 or $2 million. And this is because you have to file your, I think it's Form S1 or registration statement with the SEC, your prospectus, and then just the months of going back and forth with the SEC in terms of getting approval and the accountant's fees, lawyers' fees, everything involved. It just gets a lot. And but the beauty of the IPO is once you have come on the other side of it, hey, now you have a public float or market for your JV interest. And so that allows you to sell to a broader market. Another thing that a minority JV party can negotiate for is an auction right. So this lets them initiate a sales period, sorry, a sales process that benefits them and kind of gets them out of some of the other issues surrounding transfer restrictions. So going back to one of my earlier slides, if there were one major takeaway I would really want the audience to take home is the distinction here between traditional M&A and JVs, and that a JV is going to have to be much more, a lot more intent behind it in terms of structuring the relationship between the parties because I mean maybe might not be completely an apt analogy, but to me it kind of sounds like a prenuptial agreement, a post-marital agreement that kind of says, this is what's going to happen. I guess if you want to compare divorce, fortunately, to an exit strategy, these are the rights each person is going to have that will prevent, shares of this marriage preventing one person. If you could, break it down into subunits, but maybe an apt analogy. But again, traditional M&A, it's like we signed the deal. Fawaz goes his way, Noshir goes his way. Buyer's probably not going to stick around to help me. Seller's not sorry, seller's not gonna stick around to help me, the buyer, manage the day to day. Maybe there's, I don't know, maybe not. Whereas here, because you have majority and minorities, the minority is gonna want to put limitations on when and how the majority gets to transfer its interest. Because if we go back to the definition of a joint venture, why do they come together to do this? To combine their resources and capabilities. So if Fawaz and I come together and I'm the 25% JV interest holder and he's the 75%, in other words, I'm the minority and he's the majority. Hey, we came together because we're both experts in selling widgets, okay? But who's to say Fawaz can't go tomorrow and sell his interests to Jane Doe, who maybe was willing to pay the price Fawaz wanted, but doesn't have the expertise or is going to make fundamental changes to the business structure that impact negatively my intentions of going into the JV to begin with. And then something I guess a majority is going to be focused on is preventing the minority holder from holding up potential sales that it wants to make with respect to the business of the JV. And that kind of goes to drag along rights, where we mentioned that a majority JV interest holder can force a minority JV interest holder who didn't want to participate in the sale. Maybe they haven't gotten their upside yet. Maybe they feel like there's still much work to do, much more value left to extract. Hey, they have to be party to the sale too against their will. So the beauty of this is it's all, being on the corporate side of this, being the attorneys holding the pen on this, is you get to really get to know your clients. You get to know what they're worried about. You get to learn their short-term and long-term ideas and expectations. You get to help them craft this tailor-made deal that maybe they didn't get the perfect deal that they wanted, or sorry, by perfect LLCA that they wanted, that gave them every right that they wanted, but maybe it's more balanced because of, thanks to us in helping them negotiate with the other side, with their counsel, to get to a place where the JV parties can start, actually start the show and progress with their longer term relationship, as opposed to an M&A deal, which, like I mentioned, it's said and done. So again, most important takeaway is this is going to be a longer uh, time duration, which means that as the lawyer, you are tasked with maybe thinking of some and envisioning some and getting creative in the process, some future outcomes that you might want to have your client benefit from or be protected from. So that's my uh, presentation today. So if anybody has any questions, I'd love to help answer them. Otherwise, happy to hand it back to you.
Yeah, absolutely. Thank you so much, Nasher, for going through, which is a really complicated topic, but your slides and your presentation kind of broke down the areas where you see friction and how things need to be massaged and worked through, really. We got a couple of questions that came in here through the chat. So let me read through those. And if anyone else wants to chime in with questions or comments, feel free to. The first one was a little bit of a commentary slash question, I suppose. I understand the nuances of joint ventures a lot more, and thank you for this presentation. But where do joint ventures usually sit in the org chart? And I think maybe I can help answer this a little bit as well, because there's a thought that when you think of, okay, we're going to start, Noster and I are going to start a car wash business, we can form an LLC, him and I can be members of it, and we can start, go off to the races, right? And that structure absolutely in principle can work. What joint ventures really is talking about is if Nasher and I come together because we're going to build 50 car washes, 10 car washes, right? And so this entity would sit on top of, when you're looking at your org chart, would sit on the top of, be at the very top of the entity that holds maybe more LLCs on the bottom, and each LLC it holds perhaps as its own car wash, right? So the idea, you're not too far off from this question being posed. Of isn't a joint venture really just like any other regular multi-member LLC that happens to be running a business? Yes, but think about it a little bit more nuanced, because it should be kind of the leadership up top. And for all the reasons why Nasher mentioned, which is you get to pull in more members. If you, as you finance each one of the car washes down below, the lender doesn't care as much about your joint venture and who the members are. They still care, but not as much, because it's a couple of steps removed from the car wash business in that example. So not sure any other color you want to add to kind of help drive home the point of why joint ventures mean a lot more or make more sense. Oh, and you're on mute, sorry.
Thank you, Fawaz. And sure, I think you hit a lot of the important points. I think just the way that the deals that we see, their complexity and their scope, and just the massive amount of money and sub-entities and affiliates and parties involved. The JV structure helps you keep a really clean upstairs, and you make whatever mess you want to make downstairs.
That's a really
So
good way of
maybe
visualizing it. Yeah.
maybe it's adding layers of complexity, but also like sometimes you see these org charts and you're like, wow, this is like layers of an onion or a Russian doll. But there is a reason to the madness. There's a rhythm to it, and like to Flaws's point, this is kind of going to at a very high level structure the relationship between the parties. So all of their expectations on one page, and then they can stream out into the actual. Let's say let's say Fawaz and I come together. So I do energy. So I'll use, let's say, a power plant as an example. Let's say we want to do a JV where we want to be in the business of running power plants, right? Each power plant itself is going to maybe be comprised of like 5 different LLC agreements sometimes. So you'll have maybe we have different words for them like blocker, uh, operator, stuff like that. So there's so many different. Sometimes you get the LCAs, and then you also have LPs involved. So I guess the JV, the joint venture idea, is more of like a high level. It doesn't kind of be like a master, kind of like when you look at Fawaz's real estate, right? So when
Yeah.
you have what is it, like a master plan, or like let's say residential, like HO, you have whatever like the governing agreement gets called, and then everything kind of splits out
Flows from
under,
there.
right?
Yeah, I always think, and this is really good analogies. I always think about it as like enterprise level, and then this is what brought us together, and then here are the lines of businesses we're going to pursue. That JV could have car washes, dealerships, residential, and each one of them would be their own arm. There's distinct liability protection that is achieved by keeping the upstairs, insulated from all the items that are going on downstairs. There are numerous tax benefits in the same vein that, depending on the members that are coming in and how the money's flowing in, it allows each of the members to do something maybe a little distinct as well. And then as simple as, when you're thinking about employees and hiring employees, well, in management of the actual business, all of that gets parked downstairs, to use Nasher's example, versus affecting anything with your JV. So your JV is relatively above it all, right? Is not getting down and dirty, even though it has control rights and even though it has directive rights. It is not exposing itself to unnecessary liability. So there are distinctions, but absolutely the question is apt that looking at it, it almost looks the same, and it's hard to understand, well, why are we going through this minutia, but there are benefits there. The next question that came through is in regards to the drag along rights and the put options and the ROFR and ROFO, I think, more in particular. But um, the question is, have you seen a general category of preemptive rights, meaning that you want both a combination of the ROFR and ROFO? And have you seen how that's put together? Is it repeated both ways, or is there another concept? If
I
you,
would say, I would say, you know, there's a lot going on in that question, and um, there are distinct concepts. And I've seen, for instance, maybe not in the JV context, or maybe Fawaz can help too, but you'll have registration rights, where if the securities get, sorry, if you end up maybe going through an IPO, then
Mhm.
Fawaz, you can add more color to this, but basically, um, allowing maybe the parties to go public, where they're able to go register the interest on a public exchange. I've
That's right.
seen that preemptive. I've done due diligence where I've seen it come up, but the idea of affirmative rights and the negative rights, these are more, I guess, educational concepts. Like in the actual agreements, that's not what they're going to be called. You're going to have
Hmm.
what I mentioned, like for instance, ROFR, ROFO, audit rights, information rights, access rights. I guess affirmative and negative are kind of just concepts or buckets to help us conceptually understand it, understand
Yeah,
these distinct rights.
you're absolutely right, Nasher. The idea, the wonderful thing about JV agreements, which also make them a little harder, is it is a private agreement, right? You and the investors, and again, not every investor is equal. Um, as Nasher mentioned, some are bringing in sweat equity. They have the know-how. Others are bringing in the money, and then each one of them comes in with baggage of, hey, on my last deal, I got burned on X, Y, and Z. So there's a lot to parse out on these JV agreements where everyone's kind of bringing in their unique experience to the table. But all that to say that the ROFR and ROFO concept and all these affirmative rights and negative rights that Nashar was mentioning is culminates in some sort of like give and take of, okay, well, we'll open it up for ROFR rights, but understand that you want notice of any sort of sale option or marketing thought process that might be going in because you, investor, had a bad experience and you want to be in the know, even if we're thinking about marketing, sure, we'll go ahead and give that to you. What you'll find is there is a quote unquote market, just like all transactions that happen in the US, we always look to figure out what is the quote unquote market. So it is not unusual for us to say, okay, well, investor, that's a great idea and that's a great thought that you have. it's just not market. No one asks for this. This is beyond the pale, beyond the scope. But we'll try to accommodate you a little bit, right? And again, if that person is Warren Buffett coming in, we will absolutely accommodate you because in many ways you might be the market, right? So to answer the question, it is a little complicated. It's not like you just check boxes on an agreement and activate them. There's a lot of negotiation behind these are the options, but look, the power dynamics here don't allow you to weigh in on this. Even the tag along and the put options, right? There's a lot of time that's spent on, well, what's the pricing on that? Are you going to be able to exercise on the exact same price that everyone else is exercising? Is it going to be a different price? So as you talk to, and that's why these JV agreements get a little complicated sometimes, the more cooks in the kitchen with their lawyers, um, it can make it fairly complicated, but the concepts here hopefully have broadened your horizons on what is possible and what is not possible, and what is normal and quote unquote market to at least ask for versus you can ask, but hey, probably not going to be given.
Sure. Well, thank you so much for that. And I guess this reminded me of one of the points I was telling myself I should make is uh, some of these slides and writes in and of themselves could be entire presentations. So this is trying to pack in a lot into one presentation, but I guess that's why I had my key takeaways, as compared to my bread and butter, which is M&A. This is kind of a different beast because the more drawn out, longer temporal scope. So you have to really be creative and think what your client might want in the future and what they might not want to happen, and be able to negotiate those rights kind of in anticipation.
And I will say you just hit on the head there, Nasser, about how we can really level up with our clients, right? No matter what, even if we're starting a business or think about investing in a business or something on our own, the idea of leveling up by pointing out these concepts to your client that, hey, have you thought about what happens if there's a tie? Oh, okay. Have you thought about what if the other guy wants to sell and you don't want to sell? What kind of protections would you seek? What would you want? What is a business arrangement between you two? And as painful as we all know as it is to have these conversations at the get-go when a JV is being formed, a lot better to do it then as opposed to once the ink is dry and you find out, okay, well, Nasher's leaving the JV and oh, wow, we don't have any protection for that. And he sold it to, Elon Musk, and Elon Musk is coming in and I don't want to be in business with Elon, and that's kind of the concept we get back to. So some of these are really important to kind of think about with our clients and out loud. And you get a lot of bonus points for, oh, well, you're making me think, you're earning your keep, you're actually providing me service and not just charging me a bunch of money. Next question here is, what are the best ways to do an evaluation or valuation for the JV interest? Is that different from valuation related to an equity interest in an LLC or corporation? Not sure. Have you seen that before?
Valuation, I haven't been involved in that side because that might be more of a commercial issue. But I guess if we think about and consider some of the previous things we've mentioned, when you have so many downstream entities and their own businesses, it's like the answer to most things in life is it's complicated. Uh, maybe what I've seen is, most JVs are privately held.
Yeah. So they don't really
So
have an easy way to complete that valuation process. But you're right on the right track there, Nasher, because if our car wash in that example is doing gangbusters, right? You have a way to account for all the money and funds that are going up to the JV that are getting distributed, right? So when you're thinking about selling it, you then are thinking about, okay, how many multiples do I want on that, right? And um, from what I've seen, there's not any sort of direct norms on Can I only ask for a 10x or a 20x or a 30x, right? It really is what you want to be able to demand within reason, and also tying it to, well, we're about to launch a second product down here or a third product down here, and that's just going to up your multiple even more, right? So you're kind of selling them on kind of the same way when you purchase a house almost, of, hey, you're in a good neighborhood, good schools, and oh my God, they're opening up another park next door, right? That's going to improve your appreciation on your value. So it is a little bit of an art versus a science per se. Nonetheless, the science part of it is, what are your multiples? How strong is the business? Is there year-over-year growth? Is it a hard sector? Are there regulations coming out that are going to detract from it? That'll affect valuations tomorrow. So it's valuable today, but tomorrow we know there's something coming down that's going to turn it off. And then the other thing that we've seen also is, you might it depends why the interest is being sold, right? There is a notion that, okay, it's just him and I in this JV. We've got a successful business, but we want to expand. In order to expand, we need a cash infusion. We need an equity investment, essentially. But we're going to bring that person in on likely that investor is going to want a preferred return. That means he gets paid first before we get paid out, right? And Nasha kind of covered some of these items in the slide. So that changes the dynamic a little bit, right? You're not selling to cash out, but you're selling to bring in somebody that is going to give you $1 million, $5 million, $10 million that you can then deploy, start a new product, start 7 more locations. But that person is going to want a preferred return. So that makes them feel entitled to ask for certain protections that we've kind of covered here, but also that they get a premium. They get paid out first, and they get a premium on top of on their investment, to ensure that they are being compensated for the risk that they're willing to take, because our venture might fail, and they want to make sure that they get paid out as much money of it as possible on the outset. And that means, in that example, Nasha and me are not getting paid until we complete payment of the principal back to the preferred, and then the preferred still gets a distribution, but then we might go pro rata pari passu on distributions. So that's a good question, but hopefully we helped answer it a little bit.
And one thing I'll mention that I covered is, sometimes when you have tag-along rights, they'll be subject to certain exemptions. For instance, one thing I covered was sales with respect to a certain class of securities, for instance, preferred units. The preferred unit holder is not gonna like, the minority isn't gonna be able to participate in that sale, unfortunately, just because of the fact that they had to pause when they had to bring in an outside person. They want to have an upshot plus because of the risk they're undertaking.
Yeah, very well put. Next question here is about accounting and tax. Essentially saying, where does your role as an attorney stop when you're getting into the accounting tax area? So, not sure, have you been exposed to any of that?
So this might go to big law, or so kind of these large transactions generally, in deal structures, is first and foremost, like, 9 out of 10 times it's going to be structured via tax consideration. Tax is going to run why the org chart looks the way it does, what if this deal is even going to happen or not. I guess tax is going to be the first and foremost consideration most of the time. And once we figure out that structure, then that lets us come in and actually hash out these rights and governance frameworks.
You're absolutely right. Yeah. I think what that means also for our members is, as you start going down this path with a client, you can talk to them about these broad categories, right? But before putting pen to paper and spending a lot of time, you will want to make it very clear to them that, in concert while we're doing this, you need to check, Mr. Client, Mrs. Client, with your accountant and your tax strategist to make sure that your membership interest in this JV is being correctly thought of, right? Whether that means that, again, if this JV is an LLC, does that mean Fawaz individually is the investor, or is it Fawaz LLC, Fawaz Corp? Is that Corp then an S Corp? Is it a C Corp? What are the filing requirements? What is the cost associated with it? What am I trying to achieve, right? Um, these are the questions that we can certainly issue spot, just like we've seen in law school and talked about. But what we really try to drive home, and again, in different firms, yeah, a lot of this is done in-house, just like Nasher saying, like, let's get the tax stuff well underway because that's going to drive what this JV really looks like. There's no point of negotiating a whole JV with all these bells and whistles only to come find out that the tax attorneys are saying, wait a minute, if the tag along gets triggered, you're going to owe a huge tax bill. You don't want a tag along, right? And, again, just as an example, those are things that you want to kind of pre-clear, and we direct our clients into the same category of, have you had the conversations with tax counsel? Because that does drive a lot of structuring on the JV side, and it's important. Someone that's done multiple JVs, less of a lift. Those that are kind of getting into something new, again, your JV investor partner might be more sophisticated and has done a couple, but if you haven't done it or your client hasn't done it, it is important to level set with them that is as equally as important as all the conversations we're having here, right? And again, if it's a simple car wash, one location, it won't be that crazy of a lift, but you want to identify all this stuff because once the JV is baked, it's very hard for it to switch gears because it impacts all the investors then, right? Switch gears because there's some sort of tax consequence that was not contemplated.
Sure. And this isn't necessarily JV related, but with respect to tax considerations, I mean, something that just very recently on a deal, public M&A cross-border deal I was on, something that came about and something that took a lot of time on my end was we have a Canadian company that is being bought by a US company, right? A public M&A deal. The Canadian company is listed on the Toronto Stock Exchange. The US company is also public. They're listed both on in Toronto and on the I think the NYSE, right? And so one issue that came about was, well, the way they structured this M&A deal was that the Canadian seller, the shareholders would get cash and 20% of the shares in the US buyer, right? So a cash and share deal. So one issue that came about was, for the US citizen shareholders in the Canadian company who was being sold, what would be the tax consequences to them if we were to do this M&A as a classify as a reorganization or not as a reorganization? Because the reorganization, from what I understand, is it would have been tax deferred, whereas without reorganization, there would have been some sort of tax liability to the U.S. shareholder. So I had to prepare two merger agreements, one incorporating all of our tax team specialists' comments on this is what it's going to look like if there's a reorganization. This is what it's going to look like without a reorganization. Because our client, they're Canadian. We were representing so we were representing the seller. They needed help with the U.S. tax stuff and with the U.S. securities uh, uh, laws issues. So we kind of had to show them the ropes in that respect and prepare two different deals doing the same thing basically, but just driven completely by tax considerations.
Yeah, very, very well put. Very well example. And someone else asked for another example. So we're currently working on one where we have a client that owns about 25 industrial sites, right? They bought, and so this one might be relevant for our members. They did the hard work of buying each one of these assets, vetting them. They're all owned technically under one LLC, even though they shouldn't do that. All owned by one LLC. Now, they've got interest from these large private equity firms that love the idea. I love the ideas of having a outfit that's already purchased a critical mass of portfolio of real estate. So for our client that wants to cash out, he could do two things. He could refinance all these properties and do cash out equity finance that we all kind of know of, or he could sell a participant interest essentially in each one of these properties that have tenants that are paying rent, right? So he's opted for that for tax reasons and for long-term benefit reasons. And what that means is, so here's the LLC that owns everything. Now we're building a JV, a couple layers, but a couple up here, a JV entity up top that the three private equity firms are participating in. And we went through all these categories that Nasher mentioned here. And what will end up happening is when they purchase officially, that cash that comes in will go over to our client, which was the sole owner of all of these properties, right? So it diversifies his risk pool, liability pool, allows for getting out cash, building relations with investment firms for future expansion in the next 10 years. So there's a lot of other reasons to think about a JV, and when you're pitching ideas of, to your client of like, why do I need to set this up right now? Well, who knows, in 5-10 years, you might, if you do execute your business plan, I think that's where you want to go. So take the energy and time to think about what liability looks like, what taxes look like, and set yourself up for success. So I think that was the very last question we had. If anyone else had any questions, feel free to drop them in the chat or in the Q&A box. Either way is totally fine. I'm not sure any closing remarks or thoughts. I'm going to put up the CLE code here while you do that.
Sure. I think as somebody very junior into this, there's a lot of commercial jargon, there's a lot of business terms that you may or may not have prior exposure to in your law school career or maybe before, and that's fine. The beauty of this stuff is, hey, it's not rocket science. We aren't, building SMRs here. Like, you can go into Harvey, you can go into ChatGPT. Each and every one of these terms you can self-learn. It's gonna be all right. And when you really get into it, a lot of these are common sense. To a certain, if you take the title aside, the specific names of these rights, a lot of them make common sense. Hey, this is because out of my own economic self-interest, this is why I want to be protected, or this is why this person might think of my economic self-protection as a threat to their own economic self-protection. So once you can boil these down, they tend to very simple. So yeah, there's a learning curve, but the beauty of this stuff, and for if there's any law students among us considering a career in transactional law or corporate law, is very accessible at the end of the day, even though there's a learning curve.
Yeah, very, very well put. Just want to read out the CLE number in case someone didn't see it, but it's 174296354 for self-reporting on the site. And again, can't thank Nasher enough for putting this together and coming on to educate us and exemplifying his expertise. Obviously, feel free to reach out to him if you have particular questions or want to understand the space a little bit better. But thank you, Nasher, so much for taking the time.
Thank you for us. Thank you for having. Thank you for giving us this wonderful platform and communities.
Of course, of course. Well, we'll look forward to seeing everyone here soon. We have a couple more activities before the year is rounded out. So make sure if you're not signed up on the site to dfwmuslimbar.com that you are. And we post there pictures and event flyers and whatnot. So feel free to make sure you're connected. Take care, everyone. Assalamu alaikum.